I just read that about 6 out of 10 investors are comfy holding their portfolios, waiting this out. As a contrarian, as a technician, that tells me we're probably not near the bottom yet. How do you read such information, Mark?
Yeah, we may not be there at the bottom, but I think it's fair to say that investors are quite defensively positioned right now. There's certainly a lot of demand for interest rates at present. At the front end of the curve, we have negative rates. Towards the back end of the curve, we're near all-time lows, at least in 10-year rates. So that defensive positioning is certainly evident in the rates market. And, that's not to say that things cannot get worse from here, but I think it is fair to say that most investors are kind of hunkered down and they're waiting to see how this virus story plays itself out.
Now, according to my math, we have about $153 billion of short-term supply today. 37-day cash management bills, $60 billion, $51 billion at 3 months, $42 billion of 6 months. I know that you've been writing quite extensively, along with many of your peers at BofA, about how short maturity supply is going to go through the roof. How do you read opportunities for investors there, Mark?
Yeah, well, we're expecting an increase in yields at the front end of the curve, given all of this supply. We think that we could see 450 billion or so of front end supply just in the month of April alone, which is very, very high for the rates market. Now, you've had negative interest rates at the very front end of the curve, and that indicates that there's just a tremendous amount of demand for very short-dated securities. But we think that that's going to be fleeting because of this big wave of supply that's going to be necessary in order to fund the deficit and to get that cash out to Americans in the next few weeks, as the Treasury Secretary has indicated.
Now, with mortgage-backed securities, MBSs, these are really starting to get a bit kinky, of course, because the buying that the central bank is doing is creating distortions, and the supply really hasn't hit yet. How do you read the mortgage-backed security market, and how will there be distortions on that front versus some of the other supply-side issues like corporates that the buying of the central bank has to help these markets to achieve the type of liquidity to keep the gears turning?
Yeah, it's a great question. In the mortgage market, we've witnessed pockets of pretty severe illiquidity across various products in the mortgage space. The Fed has been very aggressive in buying agency mortgages, Fannie, Freddie, Ginnie type securities, and that has helped a lot normalize that market. But there's still aspects, the non-agency space and in other parts of the mortgage market, that are really still struggling right now. And we think it's going to be probably another few weeks before that works itself out. But what the Fed has been doing is very, very helpful in trying to get the mortgage market functioning a bit more orderly. But it's almost like if they press too hard in one area, you can start to see pockets of illiquidity in other areas. So it's probably going to be a little while before that market is more comfortable and more back to normal.